Hello and welcome back to another episode of the Investor Financing Podcast. We've got a great guest. We're going to talk about somebody who's been in the real estate investing game, not since 2 years ago, but somebody who's been around since the downturn that we all forgot about in 2007. This gentleman's done thousands of transactions. He's helped coach many thousands of students. He's done the single family, the duplexes, the fourplexes. He's obviously eventually evolved into doing bigger deals in multifamily, which seems to be a common thread with a lot of people that really want to grow is getting into multifamily. But I think today's conversation will be great because we have somebody that's been around and was probably picking up properties for like $1 back in 2007. And he's seen this just kind of robust growth we've seen, and also somebody that's in the Midwest. So there's a lot of opportunities. I've always been a fan of the Midwest, that it's just like you're not going to see the crazy appreciation usually, but you're going to see solid, working class, good rental properties. So welcome to the show, Josh. How are you doing?
Hey, I'm awesome, Beau. Thanks for having me on, man. Thanks for the intro. The only thing you didn't include there was the word crazy, which, I have to be a little crazy to do all the things I've done. Probably add that to the bio as well. But thanks for having me on.
Yeah, it's great to have somebody with so much experience because, I interview a lot of people and it's like they started investing in like 2018 and they've never seen a turn in the market. They've never,
Sure.
dealt with a lot of the stuff that you've dealt with over like a long career. Back in the day, you were like a financial advisor, and then you realize that I could get into real estate. It makes more sense. I already understand money, and real estate's probably the single best wealth creation tool out there. And so it's good to have you here. Kind of like today, now you've bought in over 4,000 multifamily units. You currently operate 3,000 doors plus, and so you have a big net. Big list of investors because you're doing syndications. So you're the general partner, and then you have some LPs that are investing in your deals. You're doing heavy value add deals, which basically, for people that are watching this, what he does is he goes in and he gets properties that are B or C class properties in good areas where he knows he can go in and renovate the units and then increase rents, and that forces the appreciation. That's a beautiful thing about multifamily. You can force appreciation. So today we're in an interesting time. We're almost halfway through 2022, and we've got rates like going up crazy. I do a lot of financing myself, so I'm doing a lot of these fix and flip loans. I do some bridge lending. I do some of these DSCR loans, and I was quoting rates in the mid fours for these like single family duplex type of properties. And now they're like, I think I just quoted one that was 7% yesterday on these 30-year rental loans. So the rates are going up. Like with all of your experience, where should an investor like mindset be pivoting right now? We'll talk about investing as an LP in syndication. If you have capital, you want to invest with a good operator and somebody who's got a track record, who's done many syndications. But like for the investors that are out there right now that are doing the duplexes and fourplexes and so forth, what advice in this kind of market cycle are you still pretty bullish? Is it because it really comes down to just finding good deals? And hey, if you find good deals, you should be buying.
Yeah, absolutely. So there's certain markets, right? You mentioned it, Beau. There's the Sun Belt. There's the coastlines. Those are what I call boom and bust markets, okay? Where people are buying, they're not getting cash flow, and so they're buying for appreciation. And when appreciation happens, it's typically because interest rates are very low and there's a lot of demand. Obviously, that's where we've been for the last several years. But wealth is truly made in assets that cash flow. So the Midwest, the Southeast, and so it really depends on the operator's strategy. There's definitely a lot to be said for areas like Phoenix, Austin, and Orlando, which are the top three. If I was going to invest for the next 20 years and purely focus on appreciation, I would focus on those markets. Phoenix, Austin, Orlando, Sun Belt, buy them. Now, today, those deals aren't going to cash flow. So what's going to happen is now investors are buying and they're almost overpaying. Those investors are almost all getting some sort of bridge loan because they can get the most leverage against the purchase price. And in the past, the last really 2 or 3 years, especially with COVID, interest rates super low, right? Property value is still relatively low, and the leverage really high. So you could get into these deals with very little money, and so investors are buying now. What's going to happen is, as interest rates go up, and as the market sort of cools off a little bit, because markets always cool off when the cost of money goes up, what will happen is can those investors that bought with bridge debt, can they refi, right? So we don't have a problem right now in the residential market. The residential market is on fire. It's going to stay that way simply because of supply and demand. We need way more supply to provide enough for all the demand that's out there when you're talking about the single family market. There's so many institutions that have bought those properties. There's so many people that have scooped those up in huge portfolios and turned them into rentals that the mom and pops that want to live in them, there's less inventory than ever. So here's what I think is going to happen, Beau. If you want a prediction, I think over the next 18 months, interest rates are going to rise. They're going to continue to rise. The market will cool off. The Fed is going to overcorrect. They're going to raise interest rates too much. We're going to go into a recession for about a year. And the Fed's also going to realize that they screwed up, because they do this all the time. Every single time they do it. And then they're going to pull back on interest rates. So about 24 months from now, I expect interest rates to be dropping back down. So the only people that are going to get caught because of their financing, look, you only lose money in real estate if you have to sell or refi at the wrong time. What's going to happen is the wrong time to refi or sell is going to be roughly 12 to 18 months from today. Okay. That's going to be the time where we're in a recession, is my guess. My best guess, based on all my experience, that the interest rates are going to be at the highest, demand will cool off, and if you have to refi at that time or sell, it's going to be more of a buyer's market than a seller's market, and it's going to be tougher to refi. If you can wait out the next 2 years and continue to buy your assets, own your assets, cash flow those assets, and not have to worry about refinancing till 24 months out, I'm going to bet that interest rates come back down, because we're going to then be in a recession. We're going to need to spur the economy, which means we need lower cost of capital, and then rates will stabilize. Look, the rates we saw a year ago, the 10-year treasury was at 1.6%, and rates for commercial real estate were at 3.25%. That's not coming back, okay? We're still at historic lows. But when we level out, and if interest rates for commercial real estate ends up leveling out at roughly 5%, that's still historically low costs of capital. So I'm excited about it because we've invested for cash flow, not for appreciation. And I don't have any assets that are going to get caught in the next 18 months that I need to refi or sell. So I'm excited about that for me because I'm a cash flow investor. So I don't know if that answered your question, Beau, but that's a little bit of take on what I think is going to happen over the next 2 years.
I agreed 100% on everything you said. And I mean, isn't it historically shown that after every time there's been a recession, rates drop down? So the writing's on the wall, unless there's some kind of black swan event, that this is probably what's going to play out. So you really don't want to lock into like a 5-year prepay right now. If you have to take a lock, you want to maybe go 3 years max so you can get out of it and refinance when the rates come back down. And if you're buying for cash flow, the only time I've ever gotten in any trouble in real estate investing is when, you didn't have the end in mind. And that's the people, that's what I thought too. These people that were kind of bullish, right? They're underwriting multifamily deals right now, and they're in bridge debt thinking they could get like a 3.8, 5-year fixed on agency debt. And now now it's going to be 5% or whatever, 5.25%. And that's going to put them not in a non-cash flowing position, because people on the different coastal communities seem to be like grossly overpaying for properties with
right.
And they're not taking into account, like they think that rent growth is still going to be 20% a year plus, and that might not be that sustainable.
No.
Right? Like
already in some markets starting to level off, like the rent growth rates that were 19, 20, 25% a year or two ago. And then during that second half, after the COVID summer happened, then things started to unlock in late 2020, 2021 was an absolutely banner year for rent. Rents jumped up in every market. I'm from Cleveland, right? I'm born and raised in Cleveland. I still have about 1,300 units I own in Cleveland. I'm from the greater Cleveland area, still live there. I was blown away to see rent rates in Cleveland jump 10%. That never happens, right? But that's going to level off now because as more inventory is happening, I see new construction going up everywhere, right? Because we know we have low supply. So as rates go up, people can't afford as much. They're going to start buying less of a house or renting less of an apartment. And developers, guys like me, we're going to be building more smartly. It's not going to be just counting on these massive increases in rent. And over time, that's going to level off. Now, there's some markets, Beau, that are just so built for growth, like Phoenix, Austin, and Orlando, that those are winning markets, I think, no matter what. I'm not saying you just go buy anything and be a cowboy about it. But I think if you buy smart and you buy for the long term, you're 15, 20 years from now, you're not going to regret buying in those markets and just buying and holding and cash flowing and holding and cash flowing and holding. I think you're going to make a fortune in those markets. In my markets in Cleveland, I'm in Cleveland. I own 700 units in Houston. I own another 1,000 units in Atlanta. Those markets are markets where we bought C-class type of assets, renovated them up into B-class, brought in a whole new tenant base, and jacked the rents up $300, $400, $500 because we really renovated those buildings. So that was really not based on appreciation, but it was based on a heavy cap construction and CapEx program. Okay, so you got to have the CapEx to be able to do that, the construction team to be able to do that. That's one model. So I look at the market right now, Beau, in two separate camps, A and B. A is you buy in the Sun Belt, you just hang on and let it grow. Okay, not a lot of CapEx to do. In the Midwest and the Southeast, there's an opportunity to buy some assets still at lower price per door, but doing heavier construction to create new product. Right now, there's not a lot of construction in some of these markets. So if you buy a C-class building and renovate it without building new, but by the time you're done, it looks new, that's a winning formula. I just bought a building, Beau, last week, $16.3 million. The insurance company quoted us and was ready to close and canceled the insurance at the closing table. You know why? Because the cost to build brand new, the building that we were buying for $16.3 million, was $42 million replacement cost. So the cost of construction is very prohibitive. So if you can buy a value add, buy it, renovate it, hold it, don't worry about selling it, I think you're going to make a fortune. That works in every market. It's going to work for now, for the next 3 to 5 to 10 years for sure.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hello, Beau Eckstein here, host of the Investor Financing Podcast. Are you a lender, real estate professional, or vendor that provides products or services within the real estate investing and business owner space? We are offering a few sponsorship opportunities to get in front of a highly targeted audience. If you're interested, please click the link below for further information. We look forward to talking with you. Thanks. Make it a great day. What advice would you have, if somebody came to you today in the market we're in today and really wanted to get started in real estate investing? Maybe they have a couple doors. Would you tell them, knowing what you know now, to go straight into larger multifamily, or would you have them cut their teeth in the smaller space, the duplex, fourplex?
Yeah, no, I would definitely start in the duplex, fourplex space. I would do that for maybe a year, and I would immediately begin looking at assets that are between 15 and 30 doors. And because there's a lot of breakage in the small multifamily space. And what I mean by breakage is there's a lot of mom and pops that are managing those, and they're poorly managing those. And there's an opportunity to renovate those boutique properties, those 40 and under, those boutique properties, really do a nice job renovating them and get massive rent bumps. Okay. So if I'm doing direct mail right now, or I'm marketing for, resi, 1 to 4 unit deals, I'm just going to try to get a little bit different list and maybe go up to the 40 unit deals. And I'm going to use the same kind of marketing. I'm going to use direct mail. I'm going to use cold calling. I'm going to use direct to seller text messaging. All that stuff works in the small multifamily space as well. It's no different. You just have to get a good list. Typically, you find somebody that's going to have a list. Maybe they pull it from CoStar. CoStar is sort of the gold standard for commercial real estate. You can find almost any asset that's commercial in there, and you can find out who the real owner is. So I would go after those 2 to 4. I mean, we made a ton of money in those types of properties over the years. I would still try to buy something that had a lot of deferred maintenance and fix it up, and then cash flow it long term. And I would immediately begin marketing for some smaller multifamily deals as well. I wouldn't stay in the 2 to 4 unit very long. Yeah,
it seems like you just can't scale. Like you'd have to do literally, thousands like you did, right? To really grow a substantial net worth, right? And it seems that everybody kind of evolves to larger properties. It's just, a lot of people don't necessarily want to manage 4,000 or 3,000 units. That's a lot of deals, right? It takes a certain skill set to get that big. And then at what point were you always in the contracting business too? Like even when you were doing a lot of fix and flips and things back in the day, or did you later in life say, hey, let's absorb a construction company. I got the team now and put it under the umbrella? Because that's where we get eaten up is in cost, right? Like if you're not, you're able to control cost to a certain degree.
So you guys have probably heard about the book Who Not How, right? By Dan Sullivan. Fantastic book. I've been kind of studying and following Dan Sullivan for over 25 years. Even one of our companies is called Strategic Real Estate Coach, right? Instead of Strategic Coach. But Who Not How is a fantastic book. I did not own a construction company 3 years ago. 3 years ago, we were just outsourcing to other construction companies and GCs. We were doing primarily multifamily, but we were outsourcing that. We still had some of our single family portfolio left. And frankly, I suck at construction, Beau. Like I don't know anything about, I wouldn't say don't know anything. After all these years, I've learned a few things, but I know very little about all the intricate details of construction, about bathrooms, about kitchens and toilets and P-traps and flooring and all that kind of stuff. So taking the concept of, Dan Sullivan did a great job of capturing this idea of bring in the people who know, right? You don't need to know. You just need to know the people who know. And so we brought in our VP of construction, Dave, about 2 years ago. And Dave had 35 years of commercial construction experience. And Dave knows everything there is to know about building and focusing on developing commercial or rehabilitating commercial. So, Dave loves it because I'm good at raising money. I'm good at finding deals. And I've essentially created a business with 3,000 units that has an unlimited amount of work for Dave for the long, long, long time. He loves it because we kind of do the same thing on every single unit, right? It's very simple. So he gets to stamp out unit after unit after unit after unit. So, long story short, you don't have to know everything, but you do have to know the right people. And I've been really good, and my team has been really good about focusing on finding the right people and bringing them in. What I tell people, Beau, is I don't want people learning on the job. Okay. I used to do that when I was much more immature. I would bring people in who had no experience and I'd be like, I'll teach you how to do it. That's bullshit. You can't scale that way. The way to scale is bringing in people into your organization who fill a significant gap that you don't know, and their experience fills the gap for you that you're not as strong in. So not only did we bring in Dave, but we just hired Stephanie. Stephanie, all she does is accounts payable and accounts receivable and construction, the finance management of the CapEx program, paying contractors, getting invoices, creating work orders, creating purchase orders, negotiating with Lowe's, Home Depot, the major supply houses. So I would like to tell you that I'm good at construction, but I'm good at hiring people who are good at construction.
I love it. I have Who Not How on my Audible right now, and I talked about it on a previous episode. I said there's 2 books that I'm kind of like basing my 2022 on, and it was Who Not How, and then an older book called Never Eat Alone, which is by Kevin Ferrazzi or something like that. But those, I was like these are two books that if I just kind of follow their systems, right? Like, and it was just funny that you mentioned it because it's so true. Like, who not how is such a game changer. It's such a simple concept, but I love Dan Sullivan. I mean, I listen to his podcast. He also does a podcast with Mike Koenig's called like Capability Amplifier or something like that. That dude is super sharp, and he's really humble too. He's just
He's unbelievable. I'll give you another book that really changed my life, which is called The Infinite Game by Simon Sinek. Everything by Simon I would read and listen to. But The Infinite Game was amazing for me because it kind of reinforced for me the idea that I should continue to invest for the long term, the infinite game. And so the book really talks through, like, why do we invest so much time and effort into just making money now, or creating relationships for now, or creating the body that we want for now? It's really about investing for the long haul. Everybody that you see that's successful very few of them are unicorns. And a unicorn, I don't know if the definition of a unicorn is a $1 billion company that was created within 10 years. That's a unicorn in the business world. Most of us are going to create a unicorn. But I would tell you that most people are way too short-sighted in their investment strategy. They're investing for the next 6 months, the next year, the next 2 years. Simon Sinek's book, The Infinite Game, reinforced the fact that with apartments, with large multifamily, that might take 2 to 3 to 5 years to stabilize in cash flow. But once we've done that, we've got $3 million, $5 million, $7 million of equity per building. And we own 13 buildings, okay? So as we took that long-term approach, all of a sudden, my balance sheet ballooned, my cash flow ballooned, the ability to hire the better people ballooned, more people with more experience ballooned. So my mindset of investing for the long haul changed everything.
I love it. And I mean, it amazes me. Like, my brother is very successful in the financial services world. He works for a large mutual fund company, gets paid very, very well. And it's like, I always tell him, I'm like, you got to look at real estate. You got to look at what cost segregation can do. All this stuff, like, a lot of people never open their minds to this. And here's a guy that's very, very successful. And it's like, I just want to shake him sometimes. It's like, listen to my podcast. I interview guys and gals that like have created huge wealth and never had I love how you never really had a job in your adult.
Yeah, I've never had a boss.
Yeah.
I was actually in the financial services world, Beau, so I know exactly what you said your brother. Yeah. Exactly what he's up to, right? In the financial services world, and I'm going to talk shit about that industry for a quick second. But David Swensen, who's the Yale Endowment Fund manager, he grew the Yale Endowment Fund to over $30 billion, and roughly 40% of all of the Yale University's expenses are paid for by his endowment. He built it from $1 billion to $30 billion. Okay, so this is a freaking genius who puts kids through Yale who go on to change the world. He did it because of his financing. He calls mutual funds the ultimate fee factory, okay? And he says all these people are selling mutual funds. They're selling, fee-based mutual funds or actively managed mutual funds. And if you look at the history of mutual funds, there's like over 10,000 or 15,000 mutual funds. But the truth is that 96% of all mutual funds underperform their related index. So 96% of the time, you're better off buying the S&P 500 index or the bond index or the mid-cap index or the small-cap index or whatever the index is. 96% of the time, you'd be better off buying the index and you'll get a higher return. And with the index, you're going to have significantly lower fees, right? Because there's no commissions, there's no trading, all these different fees and structures like that. So your brother makes a fortune, good for him. But that strategy for me, because I was a financial planner, and I realized how much money that Wall Street makes off of fees, I realized, wow, the average investor is going to end up with about a 7% return when they blend out a portfolio between stocks and bonds. They're actually going to end up with about a 5% return net after they factor in all the fees. And on our syndications, we typically pay investors a 10% pref, and we give them equity. So their final return when it's all done is in the 20 to 30% range. Annualized. So would you rather have 20 to 30% and be in a tax advantaged investment? Or would you rather end up with about 5 to 6% after the fees that you paid? All right. It's just, now the difference is Wall Street, Beau, as you know, is very liquid, right? That's the trade-off. Multifamily is not super liquid. I can't snap my fingers and take a $27 million building that I own and sell it and turn it into $27 million in cash. Can't do that. I have to find a buyer, I have to market the property, I have to go through due diligence, financing, and maybe it closes 2 to 4 months later. Okay, so it's not as liquid. So you got to stay liquid. But if you're going to invest in some mutual funds, buy the index and stay away from the actively traded funds. Buy the index, go with Vanguard, go with Fidelity, buy the index, and you'll be good to go.
And I think everybody should have a little bit of diversity. I mean, you can put like some people are 90% real estate, which is fine if they understand the space, right? That's a good, but you can be a, corporate person and still be investing in these multifamilies as LPs. And at the end of the day, I always say, listen, if I had a boatload of money, I would just invest with good operators as an LP. That Like to me, that's like the ultimate goal. Like I have no stress. It's all on the shoulders of the operator, to the syndicator, the general partner, to perform and create good returns for everybody else. That's like, to me, is the ultimate place to be. Eventually, when you have enough boatload of cash that you just can just put your money with the right ponies, that's kind of like, and then I could be sitting on the beach. Not that I would, but I mean, ultimately, I want to have that feeling. I'm 44, right? So by 55 or 50, I want to have more freedom, so I got to do it quickly. So, I have to be in the deals now, but eventually the goal is to not have to be in the deals so much. And eventually, like if you keep on falling who not how, you're going to eventually replace yourself in the next 5 years or so.
Yeah.
With
I would tell you the other book that you should read is a good friend of mine is Lifestyle Investor, Justin Donald. Justin's a good friend of mine. He's been on my podcast. I've been on his, New York Times bestseller. Justin's done exactly what you just described. The late 30s, invested for cash flow, right? Invested primarily in real estate, a lot of mobile home parks, multifamily, some self-storage. Ended up investing in some e-commerce plays as well, but all as a limited partner. Built up the income to the point where he could retire. And his whole concept is invest and then take those dollars, and let's say 3 years from now, you can refi, get that money back, but keep equity in the first deal, and now invest in a second deal, a third deal, a fourth deal. So I'm in the book. I'm featured. I think it's on page like 105 through 120. But that book, for anybody who's looking to retire and invest for lifestyle, Justin's book, Lifestyle Investors, phenomenal read. I'm in the book, which I'm pretty proud of. Justin's a good friend of mine. But that is really the ultimate goal. And the question is you've got to just do it as soon as possible. If you've got an extra 25 grand or 50 grand, get it into some sort of real estate syndication with a really good operator. Then hopefully 2 to 5 years later, you get your money back through a refi, and you've also got equity in that first deal. Then you double down and get cash flow on a second deal. Then 2 to 5 years later, get that money back. Over 10 years, you could have created 4 cash flows from the same money, right? That's the way people get free. And where the average person, not the super wealthy, but the average person can get free. Everybody that invests with me, I've got over 250 limited partners. We've raised and deployed over $80 million. We can raise money in a day and sell out a $5 million raise in a day. We were really good at it. But I will tell you that every single one of those guys, doesn't matter if they're doctors, business people, nurses, teachers, they all just wish they had started sooner. Even if they had a little bit of money, just start sooner in some kind of syndication with a really good operator. And Beau, last comment I'll make about the operator is this. So a lot of people out there in the marketplace right now, joint venturing, okay? You have this guy that finds the deal and he brings in another GP and then another GP, and then they're kind of co-syndicating. They're all bringing in investors so they can kind of collaborate to close on one deal. The question becomes, if you're a limited partner, who's the actual horse and jockey that you're betting on? If there's a group of 4 to 6 partners that are GPs, who's the actual boots on the ground? Who's going to be there every day? Who's going to be the one managing the construction, asset managing the property managers? That's the jockey. That's the one you bet on. So that's the primary question to ask is who's the boots on the ground out of all of you joint venture partners? Who's the one guy who's on the ground? I want to know who that guy is or that girl. What's their experience in construction? What's their experience with negotiating with contract? What's their experience with property management? That's what matters because that's the person that's going to take that deal A to Z. Everybody else is just noise, okay? They're just co-syndicating, bringing in partners. Find out who the horse and the jockey are that are actually managing the property daily. That's who I want to interview. That's who I want to talk to. In my case, that's us. It's me, my partner Glenn and Tyler, and we don't joint venture with other people. It's just the three of us have bought these 4,000 units, and our construction company manages the CapEx every day. So that's who people are betting on when they invest with us. There is no other people. There's no other partners. So that's very important. So many limited partners are kind of being seduced, if you will, into a general partnership, and they're not even sure who the hell's managing the property every day.
That's really good advice because I've been interviewing a lot of people and it's this whole co-GP thing and it's kind of like it's like really like a daisy chain like and really who are you holding accountable that you're putting your hard-earned money with, and you better know who you and what their track record is and two, if there's too many co-GPs, who's really going to take on the like problems that come aboard, because there's going to be problems, right? There's always problems.
Oh, yeah.
So that's really awesome advice. Okay, kind of rounding out our conversation. This has been really, really good. How do you have a lot of energy? I can just sense it over Zoom. What's your routines? What do you do that kind of like keep you like inspired and pumping iron? What does a day look like? You wake up early, or are you not early person, or how do you keep motivated?
Yeah, Beau, I'm very average when it comes to like the sleep routine. And what I mean is I need 8 hours a day. I wake up every day at 6:15. I don't get up at like 4:30 like some of these guys. I get to get up and wake up the birds and the chickens. I'm not that guy. I get up at 6:15. I make my kids lunch every day. I take my kids to school every day, and I immediately go to the gym. I listen to tons of rap music. I love Eminem. I love Logic and Drake and Migos. I listen to tons of rap music. I'm usually done at 8:30. Now here's where it gets important. On Monday, I immediately go in the field. I haven't even showered yet. I'm still wearing like my gym clothes. I'm the CEO of a $200 million company. We have over $12 million of cash flow coming through our business every year. And I secret shop my team every Monday in my gym clothes. No shower. So that's where it starts. So Mondays, I want to see what the hell's going on. Okay. So, and then a lot of times on Monday afternoon, I'm usually on the phone with investors or on my phone with the staff. It's still Monday. We're trying to figure out what's going on. But I like to be totally free on Monday to manage my own schedule. No meetings. I like to be in the field, see things with my own eyes. Then Tuesdays is what I call a buffer day. I learned this from Dan Sullivan 25 years ago. Tuesdays, we're on this podcast on a Tuesday. I have my meetings on Tuesdays. I do all my podcasts on Tuesdays. I have a mastermind group that I run with about 80 investors. I have my mastermind calls on Tuesdays. But same thing. I get up, take my kids to school, go to the gym, but then it's more of a meeting day. It's an office day, okay? Wednesday and Thursday, if I want to go back in the field, I can. My schedule is often pretty open. It's not like I'm super scheduled up. And then in the evenings, then Friday is another buffer day for me where, again, in the gym, done about 8:30, more meetings, more podcasts, more investor calls, more of an office day on Friday. Another call with my mastermind group on Friday. Here's the key, though. I learned about 15 years ago, before I got married, I was a gym rat. And I realized that if I could get a second like boost of energy at the end of the day, around 3, 4, 5, 6 o'clock, that would carry me and my energy level very high into the evening. So I love to coach, Beau. My secret sauce, I have an 8th grader, a 6th grader, and a 4th grader. I work out in the morning and almost get a second workout in at night because I'm usually on the court, on the field, volleyball, football, and basketball. I coach them all. And being around kids gives me energy, and it makes me, kids are so awesome to be around. One, because a lot of parents are clueless. A lot of parents are giving these kids no life lessons. I deal with kids all the time. They're terrible teammates that are ball hogs, that have attitude problems, bully problems. And I'm able to work with these kids to get the whole team working together. So then that gives me energy well into the evening. But I'll tell you, I get up around 6:15. So around 10:30, I'm running out of energy. But I only, if I can get 7 hours, so usually if I'm in bed by 11:30, get up at 6, I'm good to go. The other thing is I'm a pancreatic cancer survivor, Beau. 10 years ago, I was diagnosed with pancreatic cancer. It only has a 9% survival rate. And so my diet today consists primarily of lean meat, lots and lots of vegetables, but also a lot of green juice. Because that gives me energy, and I usually don't eat until 11 o'clock. So it's not like I'm intermittent fasting on purpose, but because I don't have a stomach, the doctor, my surgeon, took my stomach out during that surgery. I can't process food very easily. If I process food, my body has to slow down. My metabolism slows way down to process real food because I have no stomach. So I can't eat breakfast. If I eat breakfast, I am toast at 5 p.m. So I've learned over time to just listen to my body, get up, work out, start my day 8:30. I prefer to be out in the field. I don't like meetings. I don't like to be tied up to a schedule. I prefer to be in the field or on the phone with people. And then again, I don't eat until 11 o'clock. That will typically carry me with lots of energy well into the evening.
Awesome. This was really, I love it. Everything you said, resonated with me. And I'm like, I knew I was going to get a lot out of this interview. And I kind of interview people selfishly, but I know I'm pulling out value for everybody that's going to watch us in the future. So I really appreciate your time. Where can people find out about your mastermind? If they're a passive investor, where's the best place to send them for those type of
thanks. Freelandventures.com is our main website. They can find the mastermind there. Freelandventures.com/passive is a direct link right into our investor portal where people can register and get an account. And then joshcantwellcoaching.com is specifically the link to the mastermind. So there's a couple resources there, and our YouTube channel, tons of free stuff, our podcast, tons of free stuff. So I would love it if people engage with us and we get to know some new folks. That would be great.
Awesome. This was the interview of the week for sure for me. And I was energized the whole time. And not everybody does that for me, but I knew from you're I had chills the whole time. I could feel your energy, which is good. So anyways, hope to meet you in person at some point. And thank you so much for your time.
Absolutely, Beau. Thanks for having me on, man. This was a blast. Thanks a bunch.